Everyone, Ben here and welcome to Motivation to Invest. In this video, I'm going to reveal Stanley Druckenmiller, the legendary billionaire trader's top 3 investing tips. Who is Stanley Druckenmiller? Well, he's a billionaire investor worth an estimated $5.6 billion according to Forbes. He made it big as a hedge fund manager for over 30 years, and he's most famous for actually coming up with the great trading idea in 1992 of shorting the British pound, which resulted in George Soros's investment firm actually making $1 billion in a single day. Now, those are the type of returns that we can only dream of, but it just shows that anything is possible in the markets. So this is going to be a really special video, guys, and I think you'll like what I've got for you.
Warren Buffett, Carl Icahn, George Soros, they all only have one thing in common, and it's the exact opposite of what they teach in a business school. It's they make large, concentrated bets where they have a lot of conviction. They're not buying 35 or 40 names and diversifying. I don't know whether you remember, Icahn a few years ago put $5 billion into Apple. And I don't think he was worth more than 10 billion when he did that. When I went in to tell Soros that I was going to short 100% of the fund in the British pound against the Deutschmark, he looked at me with great disdain because he thought the story was good enough that I should be doing 200%, because it was sort of a once in a generation opportunity.
Right.
So A, they concentrate their holdings. B, concentration, this is very counterintuitive. It really gets your attention. So it actually, in my thinking, decreases your overall risk. Because where you tend to be in trouble is if you have 35 or 40 names and you stop paying attention to one. If you have big, massive positions, it has your attention.
Right.
So the way, my favorite quote of all time maybe is Mark Twain, put all your eggs in one basket and watch the basket carefully.
Right.
I tend to think that's what great investors do. The other thing to me is you got to have to know how and when to take a loss.
Right.
I've been in business since 1976 as a money manager. I've never used a stop loss, not once. Dumbest concept I've ever heard. It goes down 15%, I'm automatically out. But
Right.
I've also never hang on to a security if the reason I bought it has changed. And that's when you need to sell. If I buy X security for A, B, C, and D reasons, and those no longer are valid, whether I have a loss or a gain, that stock doesn't know whether you have a loss or a gain. It is not important. Your ego is not what this is about. What this is about is you're making money. So if I have a thesis and it doesn't bear out, which happens often with me, I'm often wrong, just get out and move on. Because I said earlier, if you're using a multi-disciplined approach, you can find something else. There's no reason to hang on to any security where you don't have great conviction. First boss taught me technical analysis. So I use fundamental analysis and technical analysis. And if there's thousands of securities out there, and my portfolio is only going to consist of 15 or 20, I'm never going to buy something that doesn't have a great chart and great fundamentals. Look, I'm not going to lie to you. My first boss had this saying, the higher they go, the cheaper they look. There's something weird, and I know everybody watching this has experienced this, and it doesn't make any sense, but when a security goes up, every bone in your body wants to buy more of it, and when it goes down, you're fighting, making yourself not sell it.
Right.
It's just the nature of the beast. And you have to constantly remind yourself why you own that security. And just because it's going down doesn't necessarily mean you should sell it. If it's going down, it definitely means you should reevaluate your thesis, but it doesn't mean you should sell it. And you cannot get crazy when it's going up. One of the probably the biggest mistake I ever made in the business, and I knew better. Somebody asked me what I learned from this. I said, nothing, I already knew it. In January of 2000, after riding that tech boom to a T and making billions of dollars in 99. I sold everything out in January, and I had a couple of internal portfolio managers at Soros who didn't sell out, and they had these, it was a smaller portfolio, but they made 30% after I sold. And I just couldn't stand it anymore. And I'm like watching them make all this money every day. And like for 2 days, I'm like ready to pick up the phone and buy this stuff back. And, you know, there's a little devil there, and then the angel, and she's saying, don't do it. And he's saying, buy it. And I pick up the phone and I buy them. I might have missed the top of the dot-com bubble by an hour. I ended up losing $3 billion on that trade alone. I had made more the year before, but, you know, $3 billion is a lot of money. And it was all because I got emotional and dropped every tool of discipline I've ever had. And somebody says, well, what did you learn from it? And I just said, I learned nothing. I learned that 25 years ago. So you can talk about not being emotional, but it takes incredible discipline to act on that.
And if you guys did find any value in this video at all, feel free to give it a big thumbs up. That helps out tremendously with the channel. And with that being said, I hope you guys all have a tremendous day, and I'll see you in my next video. Invest safe.